Hello. Today we are going to run the chapter 9, the bond and their valuation. There are two major financial assets, the bond and stock. We look at bond first. Why? Because bond valuation is easier than the stock valuation. Usually bonds have fixed interest, fixed maturity. So it is easy to come up with timeline. So in this chapter, we will learn key features of bonds and bond valuation and measuring yield to maturity and default risk and maturity risk. We will deal with these topics. What is a bond? A bond is a borrower agreed to make a payment of principal and interest. So there is two types of cash flow. The principal and interest. And specific dates, it means what? It means maturity. To the holders of bonds, we call this bond holder. And we can say a bond investor. And who can issue bonds? Yes, the government and corporate can issue the bonds. Issuer provides payback the interest and principal. Principal can be interpreted in Korean 원금. This slide shows key features of a bond. In bonds, there are two parts, the source of cash flow. What do we call them? The first one is the par value. We also call this the face value and principal. So if not stated otherwise, we assume that is $1,000. So which paid at maturity. So write down as this. Par value can be rewrite principal. It means face value. In Korean, 액면가. So, for example, when there is the 1,000 of principal, it means a bond with 1,000 face value, and it also means 1,000 loan to the issuer. So, at the maturity, firm should pay back the principal to the investor. This is the first cash flow, and the second cash flow is coupon interest rate. Coupon interest rate is stated interest rate, generally fixed, if paid by issuer. So we can simply calculate multiply by par value to get dollar payment of interest, coupon payment. So we can write down the coupon payment can be calculated by par value times coupon interest rate. And there are two more concepts, the maturity. Maturity, it means the period until the bond must be repaid. And the second one is yield to maturity. We can write down YTM, yield to maturity. It means the rate of return on the bonds held until maturity. It means when the bond investor holds until maturity, they can expect this rate of return. So it also called the discount rate and required rate of return or expected rate of return. It has many names, so I will explain more detail later. This is the basic framework, the value of financial assets. So value of financial asset is present value of all these cash flows. How do we get the R, the discount rate? As we learned before in the interest rate part, R can be decomposed three parts, right? R equal to RRF, the risk-free rate, and default risk premium, and maturity risk premium, right? The premium means the compensation for the risk. So if there is a high risk, investor wants high compensation. It means high required rate of return. We can also interpret this high discount rate because required rate of return and discount rate are same concept. When you run corporate finance course, you will learn a method to calculate discount rate. But in this stage, discount rate is given number. So this is given number. Yeah, here is example. What is the value of 10-year, 10% annual coupon bonds if the discount rate is 10%? In this example, the specific value is given, right? And 10% annual coupon bond, it means coupon interest rate. And what is RD? RD means discount rate, and we also call the required rate of return. As I mentioned before, the value of financial asset is present value of all these cash flow. So the value of bonds is the present value of all these cash flow. So this cash flow, it comes from face value multiply coupon interest rate. So in this case, there is no stated face value, so we assume $1,000, if not stated otherwise. So in this case, 1,000 multiply 0.1, right? And then get the 100th payment. And this means principal. At each period, you get the coupon payment, and at the maturity, you get the coupon and principal. That is bond cash flow. As you can see, after calculating this equation, you get the value of bond, right? It has $1,000. As you can see, it is same with this, right? It is same with the face value. Why? Why the value of bonds is same as face value? Because the coupon interest rate is same as the discount rate. This kind of bond we call the par bonds. Par bond. In Korean, the 액면가 채권. We already learned convert between future value and present value and annuity using financial calculator. A different part is this, the PV and PMT and FV. Just N means the year to maturity. Years to maturity. And I per year, it means what? Discount rate. And PMT is a coupon payment, so it can be calculated by coupon interest rate multiply face value, and FV, not a future value, in this case face value. How about PV? How can you know this? How do you get the value? We can observe in the bond market each market price of bonds. So you can input this 4 keystroke, and solving for PV, you get the number here, right? But it has negative sign. As a bondholder perspective, if you buy these bonds, it means it's cash outflow, right? And then you get the positive cash inflow, it's coupon payment, and at the maturity you get the face value and coupon payment, so it has positive number, right? Some students ask me about the sign. In the exam, the sign is not important, but make sure to know the PV and FV should be have opposite sign. If you input same sign, you get error message. So in the exam, I will deduct some point if you write same sign in PV and FV. This is the second example. The same company also has 10-year bonds outstanding with the same risk but a 13% annual coupon rate. The coupon rate is different, right? Yeah, at the previous example, the coupon rate is what? 10%. So the coupon payment is different, right? It can be calculated by face value multiply coupon interest rate. This number, right? But the discount rate is same. In this case, bond sells at a premium because a coupon rate exceeds the discount rate. In this case, coupon rate is 13%, right? But discount rate is 10%. But the face value is 1,000, but in the market it sells at 1,184.34, right? It has some premium, so we call this type of bonds as premium bonds. In Korean, 할증 채권. And this is the third example. The same company also has 10-year bonds outstanding with the same risk but a 7% annual coupon rate. In the first case, the coupon rate is 10%. The second example, the coupon rate is 13%. In this case, the coupon rate is 7%, right? This bond has annual coupon payment of 70. So since the risk is the same, the bond has the same discount rate as the previous bonds. So in this case, the bond sells at a discount because the coupon rate is 7%. Yeah, it is lesser than the discount rate. Discount rate is 10%. Right? So we can say these types of bonds as discount bond. In Korean, 할인 채권. Investor require 10% because discount rate can be interpreted as required rate of return, right? But only give the 7% coupon. Let me summarize this. The par bond, the value of bonds is same with face value. In this case, the coupon rate is same with discount rate, right? Discount rate also can be interpreted as the required rate of return. And the second case, the premium bond, the value of bonds is higher than face value. In this case, the coupon rate is higher than required rate of return, the discount rate. And the last case, discount bonds, value of bonds lower than face value. In this case, coupon rate is lower than required rate of return, right? So we can say that is par bonds, premium bonds, discount bonds. This slide shows the change in bond value over time. There is one assumption. The required rate of return remained at 10%. It means RD is 10% over time. That is one assumption. But as you can see, the par bond and premium bond and discount bond at the maturity, the zero, right? So at the maturity, the value of any bonds must equal its par value. As you can see, this premium bond getting decreased over time. Why? Because the less coupon the investor receive, it means the price of bonds going down. What about this case, the discount bond? Discount bonds gradually goes up, right? Because they can expect the principal at the maturity. So the value of principal increase, the price goes up. So at the maturity, the value of any bonds must equal its par value. As I mentioned before, the RD, the discount rate, has many names, so students may feel difficult to understand. So let's make clear together. So in this example, the what is the yield to maturity on 10-year 9% annual coupon 1000 par value bond selling for 887. So in this case, the RD can be interpreted as yield to maturity. And how can you know this, the value of these bonds? Yeah, each market price. In the market price. So when we know the I and then calculate PV, in this case the I refers to required rate of return, and we also called discount rate. This example is here. Yeah, we know the RD, the discount rate, and required rate of return, and then calculating for the value, present value of these bonds. So we call this discount rate and required rate of return. But in this case, there is no RD, so we should solve them. And we already know the PV, the present value of this bond. It is already traded in the market. So in this case, we know the PV and solving for I, right? In this case, we can interpret this yield to maturity or expected rate of return. So the market is efficient. Market price of bonds incorporated all the information. So from this market price, we can calculate investors' expected rate of return from this. You can also use the financial calculator to solve for the yield to maturity. So in this case, you can input 4 keystroke and the number of maturity is 10 and PV, the market price, 887, the bond price, right? And the coupon payment and face value. Input this 4 keystroke and solving for I per year, you get this number. This number means what? Yield to maturity. So yield to maturity is 10.91%. But how about the coupon rate? Coupon rate is here, right? 9%. So we can say yield to maturity is higher than coupon rate. This bond sells at a discount. So discount bonds. Do you remember the slide this? Yeah, we already summarized what is par bond and what is premium bond and what is discount bond. In this case, discount rate and required rate of return can be rewrite yield to maturity or expected rate of return. This is similar concept and these two are similar concept. So as I mentioned before, the coupon rate is lesser than yield to maturity, so we can say this is discount bonds. Another example, when the market price trading the bonds is here, right? And after input this 4 key variable and we get this number, yield to maturity. But as you can see, coupon rate was 9%, but yield to maturity is lesser, right? So we can say this is premium bonds. Yield to maturity can be decomposed two parts, the expected CY and expected CGY. The expected CY stands for the current yield. It is about the coupon payment. And the second component is expected CGY. The CGY stands for capital gain yield. It is about the change in price. The denominator is same, right? So as I mentioned before, yield to maturity, it means when the bondholder have this bond, they can expect this return, right? So this return comes from coupon and change in price. And one thing you should know, these 3 yields are annual terms. For example, the current yield, it can be calculated by the annual coupon payment, not a semi-annual, so you should caution about this. And the change in price and yield to maturity is annual base. Here is example about current yield and capital gain yield. So the find current yield and capital gain yield for 10-year 9% annual coupon bonds that sells for 887 and has a face value of 1,000. So the current yield equation, the numerator was annual coupon payment and denominator is current price, right? So annual coupon payment can be calculated by here, right? Face value multiply coupon rate 9%. Yeah, it is here, right? And the current price is here, right? It sells for 887. Yeah, when you calculate this, you get this number 10.15%. How do we calculate capital gain yield? Let's write down equation first. The equation of the capital gain yield, the CGY, is equal to change in price, and denominator is current price. Now we already know the current price. Current price is here, right? 887, and the numerator is change in price, so current price and subtract some numbers. That is change in price. So how long? So 1 year. 1 year after. Because CGY is annual term, so we use the next year's bond price. How do we find next year bond price? In this case, the PMT, the payment is 90, the face value is 1,000, and the interest rate assume same. So it comes from this right, this number, 10.91%. So it is 0.01091. And what about the N? The previous example, 10-year bond, right? So in the current time, the maturity left 10 years. So we want to know the next year. So N changed to from 10 to 9, right? So 10 to 9. And solve for what? Solve for PV, right? PV means next year's bond price. You can also use the Excel function. The function name is PV. The PV, the rate is here, right? 0.1091, and number of period is 9, right? And the payment is 90, face value is 1,000. I already calculated the number. Yeah, the number is 89387. You can also use another formula. this. Yield to maturity can be calculated by current yield plus capital gain yield. But now you want to know capital gain yield. Just this move to the left hand side. So yield to maturity subtract current yield, that is capital gain yield. So write down the numbers. Yield to maturity current yield. We already know yield to maturity, that is this number. And current yield, we already calculated at the previous slide, right? This number. So 0.1051. Another one. Yeah, let me erase this. 1015. Yeah, that is the answer of this question.